Welcome. I am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone today to today's webinar, The Big Bang, Technology and the Global Economy. Much like the universe in the first few moments after the Big Bang, today's global economy is exploding with potential. Technological change has unleashed incredibly powerful forces that are upending the economic status quo and shifting the flow of money across the planet. Businesses have been thrust into a completely new reality, a world containing unparalleled opportunity and unprecedented danger. Today's speakers will discuss how leading-edge technologies are triggering upheaval in the financial system, transforming the geopolitical balance of power, and overturning many of our most fundamental economic beliefs. Karl and Andy will illustrate what this means for the currency markets, identifying some of the critical risks that are emerging, while highlighting a number of actionable strategies that can be used to capitalize on the opportunities being created. I'd like to take this time to thank our sponsor, Western Union Business Solutions, for helping us make this event possible and their generous support, for which helps us deliver this webinar at no cost, just like everything at Proformative. And now just a few housekeeping items before we get started. First, I'd like to welcome you all back to Proformative. If this is the first time you are at Proformative, welcome. We are the largest growing online community of finance, treasury, and accounting and related professionals. We are an ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. Just for some event notes, the links to today's presentation and recording of this webinar will be sent out to all attendees within 24 hours of the event. The presentation itself is currently available online at proformative.com/resources if you'd like to download it and follow along. Those of you who would like to receive CPE credits will need to answer all 3 polling questions during the event today and should have pre-registered for it. For any questions on CPE credits, please contact Chris Brower at proformative.com. We encourage everyone to ask questions on today's topic via the questions box in your GoToWebinar control panel, at which time we'll go ahead and address as many questions as we can during our Q&A session at the end of the event. If we cannot get to your question by the end, we will follow up with the speaker and webinar and make sure that we do address your questions. Lastly, we encourage and ask everyone to take along our short survey at the end of the webinar. We greatly appreciate your feedback regarding our event today, as we always strive to improve the value we offer to our attendees. And our learning objectives. What can you expect to learn during the webinar today? So after participating, you'll have a better understanding of the fundamental impact that accelerating innovation is having on the global economy. You'll also be able to define the changes underway in the financial markets as the world moves into a post-industrial state. You'll also have insight into strategies that the world's most successful companies are using to adapt to and harness technological change. And at this point, it gives me great pleasure to introduce today's first speaker, and that is Karl Shimoda. He is the Senior Market Strategist with Western Union Business Solutions and the President of the Association for Financial Professionals Canada, Calgary. Karl is responsible for delivering market analysis tools and trading strategy to thousands of businesses across North America. He often speaks with financial audiences and is known for providing visually compelling and uniquely independent insights into the profound changes that are reshaping the global economy. Karl is a frequent contributor to a number of international finance magazines, and his market perspectives regularly appear in media such as Bloomberg Businessweek, Reuters, CNN, CNBC, and the Wall Street Journal. Take it away, Karl.
Thank you very much for that kind introduction, Carlo. And thank you to everyone joining us today. I think this should be a really fun session, at least by finance nerd standards. It reminds me of something I heard a physicist say a few years ago. I forget who it was, but he said that time is relative. If you want proof, just try sitting through a lecture on Canadian interest rate policy. And you know, sadly but realistically, that's basically what most foreign exchange analysis comes down to. So today we're going to talk about something a little bit different. We're going to talk about about how technology is changing, about the impact that it's having on the global economy and the financial markets, and then my co-presenter Andy will outline some of the strategies that your company can use to thrive in this environment. Now, why are we actually talking about technology? Because as finance and treasury professionals, we're all continually bombarded with stories about things like whether what European policymakers are saying to one another, currency war, central bank policy, etc. But frankly, we're really missing the forest for the trees. Conventional economic models and market narratives largely ignore something that absolutely everyone on this call recognizes, that technological advancements are changing the world. And this has been the case many times before in history. If you read the papers of the day, you'd have had no clue that the Industrial Revolution was laying the foundations for the longest and most astonishing period of economic expansion in human history. As a matter of fact, you'd probably have thought the world was ending. And, I think today has obvious parallels. So sometimes it's a really good idea to take a step back and look at the big picture. And before we get started, I'd like to make it really, really clear that we're simply hoping to provoke a discussion today around technology's impact. It's not really possible to quantify everything that's happening or to identify every change that's occurring. So we'll make our slide deck available after the fact, as Carlo mentioned, and we'd really love to hear your ideas. So, please email us to talk further after today's session. I'd like to start off by talking about technology itself. And in order to do so, I'd like to highlight the true game changer that I think really set the foundation for what we're seeing today. And that's the growth of the global patent system. Now, I know that doesn't sound exciting or leading edge or anything like that, but intellectual property patents meant that people no longer had the incentive to keep ideas to themselves. They essentially incentivize people to share their ideas. And when people are paid to create things, they create more of them. So, since the creation of global patent standards, people have been able to separate ideas from the commercial application of them, meaning that concepts, the new concepts in particular, could travel all over the world in a relatively frictionless manner and achieve commercial success in a range of geographies and applications almost simultaneously. And I think a great example here is the personal computer. If labs at places like Bell and HP, for example, hadn't been able to license out their new technologies, we would not have seen the exponential rate of progress that we've seen. Since 1958, computer chip performance has doubled every 2 years, effectively multiplying the power of the human brain and allowing us to create new ideas at a prodigious rate. And I'd really like to quantify that. Just after 2000, computers first successfully simulated the processing power contained in an insect brain. Kind of tells you that they're smarter than you might think. And mice are next. Now, extrapolating that rate of progress forward, and I'm not going out on a limb and making some crazy forecast here, we will have computers that exceed the processing power of the human brain around 2025, and all human brains put together by 2050. Or to measure it another way, and I think this is pretty dramatic. Your kid's Sony PlayStation, or maybe more accurately, your own Sony PlayStation, has more processing power than a military supercomputer did back in 1997. And that really underlines the fact that the rate of change here is almost impossible to understand. But the real game changer is the internet. It's allowing people to share all of these new ideas at an unprecedented rate across the entire planet. Almost anyone can participate, and this is changing the fabric of human society itself. And I think if you really look at the big picture here, ideas are the key to everything. We're used to thinking in physical terms, measuring innovation in terms of gadgets or cars or things from the Jetsons. But really, it's all about processes today. We don't have humanoid robots that are wearing jet boots and doing our groceries yet. And many people, and I've definitely seen many of them writing in the media, many of these people take this as a sign that innovation is slowing. But I would suggest that they're looking in the wrong direction. We've created a colossal world-spanning robot. It comes into your home to ask you what you want. It travels to the other side of the planet to get the goods, and it travels all the way back to deliver them, all without really involving human beings. What's it called? Amazon. And there are, thousands of others like it, businesses that are essentially collections of software-enabled processes rather than physical, tangible objects. And I think that's really underlying all of this innovation that's happening. But big things are happening in the physical world too. So I'd like to briefly highlight a few of the technologies that are really having an impact. And again, this isn't meant to be an exhaustive list, just an overview of the things that really are gaining traction and helping to change things. And appropriately enough, I'd like to start with robots. Here is the global robot population's growth over the past decade. This year, more than 20 million robots will be in operation, and the trend is only accelerating as flexible, reprogrammable ones are introduced. And this gives companies the ability to change direction on a dime and produce entirely different products overnight. In other words, you don't have an auto assembly plant that can only produce one model, but all the robots need to be switched out. What we have happening now is robots that can simply be reprogrammed to produce a new product. And of course, robots are only the tip of the spear. Advances in automation mean that building something today is cheaper, faster, safer, and more flexible than ever before. And I think 3D printers are an excellent example of this. They've been in the news a lot lately, with a lot of people comparing them to the growth that we saw for the early PC. They've plummeted in price, as you can really see here, from $187,000 on average in '88 to $299 today. And of course, you've seen something like the same size differential happen as well. Now, granted, they're still fairly limited. They're mainly used to manufacture small bits of plastic jewelry and the like. But at one point, people were fascinated by watching a circle bounce back and forth between two rectangles on a screen. And I think the parallel is quite obvious. If they improve at anything like the same rate that PCs did, they will change the world. And their importance doesn't lie in the ability to make small trinkets. Their importance lies in the ability to manufacture complex, highly individual products on a distributed basis. In other words, mass production is giving way to mass customization in this environment. At the same time, we've got the rise of web-based e-commerce, which is rapidly eliminating the need for bricks and mortar distribution facilities, otherwise known as retail stores. And this is obviously having a tremendously disruptive effect in traditional sectors, but it also means that the hobbyist in Northern Virginia, for example, with a 3D printer, or a craftsman in Peru, each has access to a truly global market. The barriers to entry have been lowered substantially by this change in technology. Another thing that I wanted to mention here, and it's often ignored, but the shipping container. It's truly changed the world. You can see the phenomenal growth here, and this is really that's just simply over a decade. Now, why did the shipping container change the world? Because it standardized the units of global trade. It turned international shipping into something really, really similar to the internet. Goods travel in a packet-switched fashion from one place to another, more quickly, more efficiently, and more cheaply than ever before. And we're all familiar, of course, with FedEx and UPS that have done something similar for smaller packages. This is really changing the fabric of international trade. At the same time, we're connecting almost everything to the internet, meaning that everything from pipeline components to your toaster oven is capable of communicating with other devices, allowing them to find ways to lower power consumption, adapt to environmental changes, and sense when repair efforts are needed. To quantify that, by 2020, there will be an estimated 7 internet connections for every human being on the planet. And all of those devices will be continually spewing out data that can be mined for patterns and areas of improvement. And I think this is really game-changing. Something else is also happening. And if you really look at the big picture, what's happening here is that on a global basis, we're moving away from an ownership culture. We're renting things, allowing us to share goods and services and let experts manage the products themselves. This might be called the as-a-service revolution, meaning that products are no longer products, they're services. Using Zipcar, for example, you pay for a car as a service. You don't go into a showroom and spend lots of time deciding what car to buy. You let the experts do that. Cloud computing means that you no longer build your own IT infrastructure. You pay for the service. You don't think about hiring your own system administration people. You let the experts take care of it. Now, why is this so important? Because it lowers entry costs. Small companies, they don't need to put millions into infrastructure in order to get started. They can rent what they need until they've grown large enough to build their own. Individuals don't need to buy tons of things that are used only once a month. They can rent them as they need them. And I could really go on all day about all the cool things that are happening here, but I'd like to talk about some of the real-world implications as this technological Big Bang unfolds. Overall, despite all expectations, we're seeing creative democratization. What do I mean by that? the world of George Orwell's 1984 has not come to pass. Why? Because technology is in the hands of just about everyone, not just the elite. That is, more people in more places in the world have been given the ability to participate in the global economy, and this is only accelerating. Some have obviously become wealthier than others, but in many cases, it is the world's poorest people that are becoming enfranchised for the first time. To show you what I mean, I'd like to talk about what happened in an Indian state called Kerala a few years ago. For hundreds, if not thousands of years, fishermen fished offshore, and they sold their catch at the markets that dotted the beaches up and down the coast. Now, while they were at sea, they had to guess which market would have the highest demand and then travel there to sell their catch. Now, this meant that multiple boats would often go to one market while none would arrive at another. You had prices varying wildly, and many fishermen had to throw the catch overboard. Now, this is in a country where millions of people are suffering from malnutrition. Absolutely ridiculous. It's a historical fact, though. A couple of Yale economists studied what happened when cell phone towers were first introduced to the area, and as the fishermen themselves got their first, really cheap cell phones, allowing them to communicate with the people that were on shore. Now, this chart really shows it. Price swings were cut down dramatically in a period of days. Volatility dropped dramatically. Fishermen were now able to earn a consistent wage and provide for the families in a much more stable manner. At the same time, the amount wasted was cut down to virtually nil. In essence, supply became almost instantly responsive, to demand. The fishermen won, market participants won, and Indian citizens themselves won. Now, this is happening across the planet in millions of ways and at millions of complexity levels. If there's demand for something somewhere, someone somewhere else will find a way to supply it incredibly quickly and efficiently. And that's what all of this technology is really doing, is providing those tools that connect these people and drop the barriers to entry for all of the participants in the global economy. So in inflation-adjusted terms, global trade is 10 times bigger today than it was in 1970. And given that it is trade and not aid that truly lifts the people out of poverty, the number of changed lives is mind-boggling. Literally billions of people have been brought into the global economy for the first time. Now, there's some things to think about here. Humanity is rapidly overcoming its most fundamental limitations. In my less than humble opinion, materials are becoming effectively immaterial. To see what I mean, consider this chart. It illustrates global energy production over the last 60 years, a period during which various illustrious world leaders and highly qualified experts repeatedly said that we'd soon run out. Production just keeps going up. And this, which shows the amount of oil used to generate $1,000 in inflation-adjusted GDP over the past 2 centuries. At one point, it seemed obvious that oil usage would go up and up forever. But at some point, every one of the great powers and the world itself became more efficient. Energy intensity dropped. And this has been mirrored in the world of manufacturing. New technologies have driven an absolutely massive rise in worker productivity. Things, physical objects, have become incredibly cheap to produce. And this has had a really interesting effect on lifestyles. The average American family spends less and less on basics every year. The share of income going to food, housewares, and clothing has dropped precipitously over the last 80 years. The only input that has risen is housing, and it isn't the structures themselves that has become more expensive over that time. And maybe I'm constraining it to the rich world there, but here is agricultural production. Yields have almost tripled, meaning that more people can be fed on less land every year. Again, flying in the face of predictions by people who have continually suggested that we're about to starve. And this has meant that the number of hungry people in the world has dropped, even as the population has risen sharply. And you're looking at a relatively short time period there, 4 decades, huge reduction in the number of hungry around the world. Now, the point that I'm trying to make here is that while it's always very popular to talk about imminent shortages or infinitely rising commodity demand, it just isn't occurring. We always have to think about this from a different angle. As new technologies are deployed, they're boosting productivity, increasing efficiency, and effectively lowering the cost of the physical inputs that we rely upon. And this means that something really counterintuitive is happening. The global economy itself is becoming intangible. And this is causing widespread disruption, especially for nations themselves. And again, what's interesting here is that it just isn't always what it seems. Crucially, as we get better at making things, it's harder to make money making things. This chart illustrates the fact that manufacturing is contributing a smaller share to GDP every year. We all know this, but let's think about some of the effects here. I read a really good report from the San Francisco Federal Reserve last year that outlined the amount of money that the average American spends on goods made in China. Now, most people, including myself, would have guessed something like 15% or more. I've certainly talked to people that thought that it was above the 50% mark. Try 1.9%. Why so low? Because the United States typically imports manufactured goods from China. They're goods you can reach out and touch, and if you turn them over, they say made in China. But automated processes, albeit using human labor as well, have made these products incredibly cheap to produce. It's services that are really building the value in this economy. And I think another Fed analysis really nails that down. The Apple iPhone. It retails for roughly $549 in the United States. $172.40 goes to parts made in a variety of countries like Japan, South Korea, and Germany. $10.74 gets spent on parts made in the United States. Only $6.50 goes to China for assembly by countries like Foxconn. The rest goes to Apple and to shipping costs. I think that really, it covers off where the value is being added. But China spends close to half of its annual income on fixed investment right now. It's investing in roads, rail lines, and factories that are designed to make the country better at manufacturing things. And this is, the highest investment level in recorded economic history, certainly that I know of. Soviet Russia didn't even come close to this. In other words, the folks running China are rather like the generals that fight the last war. Or, as I think Thoreau put it, he said that some men go fishing all their lives without knowing that it is not fish that they are after. China should be investing in creating new ideas, but as you can see, the country remains far behind other countries in per capita terms. That being said, China is rapidly catching up to other countries in the absolute number of patents filed. Now, why? Because China knows that protecting intellectual property domestically is the only way to encourage homegrown innovation and escape the middle income trap that so many economists see looming in the country's future. Now, the United States was in the exact same position 2 centuries ago, and it went through the same process. If you read your history, you see, you hear about stories of American industrialists stealing the designs for cotton mills and bringing them to the United States. Once intellectual property protections were put in place, this was mitigated. So you're seeing the same process occurring over time. And that really brings me to my key point. While many people believe that the world will become more like China in the coming years, I think we need to prepare for a China that becomes more like the rest of the world. I would expect investment to fall, for that GDP share to fall, for intellectual property protections to be strengthened, and for the entire economy to rebalance toward household-driven spending decisions versus top-down planning. And this will impact almost every area of the global economy as it occurs. Now, speaking of the rest of the world, almost every developed country is facing a different problem. As workers become more productive, fewer people are needed to produce things. Jobs are being destroyed. As we've we've certainly seen this in the United States over the past few years, but it afflicts areas like peripheral Europe, Russia, and the Middle East as well. For many people, this seems like an intractable issue. Many of these unemployed simply don't have the skills to compete in this new economy, and that seems pretty obvious to most people who look at it. As a result, it seems a very logical conclusion that jobless levels will remain permanently elevated. This does seem relatively likely, but I think that there's good reason to doubt this explanation. Conventional economic theory is aligned with this understanding of human needs. And I'm sure all of you saw this in your introductory economics class, so I hope I'm not bringing back any bad memories, but it's really quite deceptive. In essence, Maslow's hierarchy of needs says that we will always expend the bulk of our resources on our basic physiological needs, with very little going to things like esteem and self-actualization at the top of the pyramid. But I think that the reality looks a lot more like this. Once we've met our basic needs, our wants are effectively unlimited. We will always want more, and other people will always find ways to fulfill those needs. Time after time, that has been the case. The Industrial Revolution put millions of people out of work. Arguably, the Depression was exacerbated by the same phenomena. agricultural machinery eliminated the need for tens of millions of American farmers. And we've seen that pattern throughout history over and over. But for a more recent example, this chart illustrates the share of the U.S. population employed over the last 60 years. At one point in the early 50s, unemployment was far higher than it is today. Why didn't you hear about this? Because domestic appliances had just been introduced into households, rendering almost half of the workforce obsolete. What am I talking about here? The female side of the workforce. If you were an observer at the time, you would have guessed that this was effectively permanent. But women found new roles, and they helped to propel the huge gains in productivity that we saw through the coming decades, or through the following decades, I should say. Now, why? Because demand expanded even more consistently than the workforce itself, just as it has throughout human history. Now, I don't know precisely how these jobs will be replaced, or in what form, but they will be, and most likely by jobs that are far more interesting than the ones that people hold today. As Gordon Gekko put it, greed is good, and I think that really remains true today. Now, all of that sounds very nice, but another almost counterintuitive thing is happening in the financial markets. I like to think of it as artificial scarcity. Now, what am I talking about here? As the world moves beyond its material limitations, the developed countries have to invest a lower and lower percentage of GDP into tangible capital, into factories, equipment, etc. This chart outlines the trend in the United States over the past 4 decades, and virtually every other piece of data shows the exact same thing. Less money going into physical assets and less money going into labor. With that need, with those constraints waning, businesses are generating an incredible amount of unused liquidity. Much of this unlocked money is being financialized, turned into financial assets of one kind or another. It's being invested in the markets where it's continually looking for a profitable home. To illustrate that, here's a rough estimation of global trade. Last year, we saw roughly $28 trillion in goods and services moved across borders throughout the year. Now, I want to be very clear here, that's effectively double counting it. I'm counting exports and imports in there. Here's global currency turnover, with trade drawn to scale against it. So what you're seeing here is $28 trillion in goods and services, and roughly $1 quadrillion moving through the markets on an annual basis. Now, the key to remember here is that the people and the computers that manage this money are looking for yield. With so much money around and central banks continually creating more of it in an attempt to stimulate demand, interest rates are at historical lows. Some academics have suggested that they have not been so low since Babylonian times. So where is all this money going to go? I would suggest that it can't go into enterprises in the conventional sense. Apple has no need of extra cash at this point. It just can't profitably invest it. Berkshire Hathaway, I mean, just go throughout the large corporate sector and you're going to find the same phenomena. Companies that are just not in a position to invest more capital. So I would suggest that it's going to chase things that are perceived as scarce commodities. Now, what do I mean by a scarce commodity? I mean a commodity that has a story attached to it. And the story says that this commodity is limited, it's scarce, and that supply cannot respond to additional demand very quickly. Okay? So real estate is the most obvious one. They aren't making any more of it. It's naturally scarce. We haven't really occupied the moon just yet. So over the last decade, we've seen a massive inflow of cash into real estate. This inflow of cash pushed values up and provided the initial investors with some very handsome profits. The only problem is that this scarcity was effectively artificial. Soon enough, we did build more real estate. More houses, condos, and buildings were built than the underlying economy could afford. Prices crashed, and we all know about the consequences for the economy in the United States. Now, the next category is a little bit more interesting: government debt. Now, I can hear everyone shaking their head at this point. That's probably the last thing that anyone would think of as a scarce asset. But prior to 1999, investors had 2 choices in Europe. They could buy safe but extremely low-yielding German debt, or extremely unsafe but high-yielding debt from the peripheral countries. Greece offered some very, very nice rates, but it had been in default for 50% of the years since 1800. So it just wasn't a great investment, to say the least. And then the European Union was formed. Investors now believe that Germany and other core countries were ultimately on the hook for peripheral debt, So they piled in. They poured money into these countries, and that money sent intra-euro financial flows soaring. Now, you can see that here in this chart. Yields dropped to levels that were frankly almost unimaginable to anyone with a sound understanding of history. I certainly was shocked by what was happening. But here's the interesting part. As this money poured in, these economies actually became more uncompetitive. Okay? In the past, more money meant more investment in capital assets, and that meant that a country became more competitive over time. That is just not the case today. Today, what happens is that more money means more credit. More credit is translated into more consumption and indebtedness. So what happens is that externally it looks like an economy is growing very, very strongly, that everything has moderated, and there was definitely a lot of argument in the early 2000s about the European model, suggesting that it was certainly more robust than the American model or others. Economic growth was actually slowing, current account balances were jumping up, and public spending was going through the roof. Of course, eventually the party came to an end, and you can really see that on the right-hand side of that slide. So, again, we have another pool of money that is looking for a home. Now, what's going to happen in the current environment? We have this idea that China and other emerging markets are going to grow forever, and that they're going to need more and more raw materials. So we've seen an absolutely unprecedented secular rise in commodity prices. And here, the party hasn't ended yet. Prices have moderated, but speculative money continues to pour into commodity-related funds and other instruments. Now, I think you're probably asking yourself here why a currency strategist is thinking about all of this. I think about all of this because it has a huge impact on currency volatility. Countries are simply another asset class. Both the real estate bubble and the European debt bubble had broad effects on the currency world. And we've seen this in a number of other asset classes over the past 2 decades. So does the commodity price rally, and I want to really nail that down here. So this chart here shows commodity-linked currencies, which have seen massive inflows over the past 3 years. And this has sent exchange rates well beyond historical averages. And again, this has a perverse effect. When exchange rates jump, countries become less competitive. Money flows into things like housing and consumption, giving the world the impression that these are healthy economies when in fact they are not. Effectively, all this money creates a disincentive for innovation. If you look at this chart, I think it really shows it well. Portugal, Spain, France, Italy, and Greece there in the middle are still struggling to recover after receiving so much foreign capital earlier in the decade. They have still not narrowed the competitiveness gap with countries like Germany and Japan that are on the left-hand side. On the right, you can see the countries that have seen such a substantial increase in exchange rates over the past few years. And I'll just hop back a slide here to illustrate that pattern. So you can see the Aussie, Kiwi, Loonie, and the sterling there ranked from the top. On this chart, you can see the productivity levels there and the unit labor costs that you're seeing in those economies. So I would suggest that all of these are vulnerable to adjustment in the years ahead. At the same time, I would expect the peripheral European countries to begin narrowing the competitiveness gap with Germany. France is another story, partly because they haven't yet figured out that there is a problem, but that's another story for another day. I think the key here is to understand there's a pattern. Technology is being harnessed by countries to the left of that slide, which is flooding into the countries on the right, effectively creating a disincentive to innovate. And this is incredibly unbalanced, and it sets the stage for ongoing volatility in the currency markets. So just to nail that down, capital flows in, competitiveness falls, and currency volatility is the result. And that really is the only certainty that we have here. The only certainty is that we're going to see volatility. And I think that's the key. The key is to know that old school forecasting methods are dangerous in this environment. If you take a currency forecast and you plug it into your strategic process, you will often get it wrong and your results will suffer. As Darwin is often supposed to have said, it's not the strongest of the species that survives, nor the most intelligent, but rather the one most adaptable to change. In other words, for both companies and countries, rigid assumptions are dangerous. You want to look for adaptability wherever it can be found, and you want to build adaptability. So with that, I'll hand it over to Carlo, who will then hand it over to Andy to talk about how you can use technology to make your organization more adaptable. Thank you. Carlo, do you want to go ahead there?
Yeah, thank you, Carl. I appreciate those interesting insights. And now we are getting to our first polling question. We will go ahead and launch that here. And you guys should be seeing that on your screen now. Just a small reminder for those of you attending today's webinar for CPE credit, you must take all 3 polling questions to receive full credit. But we urge all participants to answer the polling question as it is statistical in nature. And if we have enough time at the end, we will share the results with you. At this time, I also want to remind you to ask questions in your question box within your GoToWebinar panel for our Q&A session, which will be coming up after Andy's section. I'll give everyone about another 10 seconds to answer it. And I really appreciate your insights, folks. And with that, we'll go ahead and close down this polling question for the time being. And at this time, I would like to introduce our second speaker of today's webinar, Andy Gage. He is the VP of Strategic Market Development for Fire Apps. Andy has over 20 years of experience in FX exposure management, business process reengineering, lean manufacturing, ERP and complex system deployment, product management and marketing, as well as consulting. Andy is a frequent speaker at Treasury and Finance conferences and educational sessions. He holds an MBA from the University of Texas, Austin, and a bachelor's degree in business from the University of Arizona. The floor is yours, Andy.
Thank you, Carlo. And Carl, that's a tough act to follow. I'm gonna do my best, but it's a great backdrop for what I'm going to cover today. We at Fire Apps are very unique in what we do, and the focus of our business is really helping companies better understand and manage their currency exposure. But we do that by working with a company's existing business systems within their risk management framework, within the constraints and capabilities of the organization. And as we've done that, working across companies from all different industries with different systems environments, different business models, we've been able to see some very interesting trends evolve, and we do see some compelling strategies that we think are beyond just what you need to look at from a foreign exchange standpoint, but really get into how organizations invest in technology to solve many of the problems that really make it very difficult to manage currency risk. But I do think many of the topics that I will cover today are things that are generally applicable across a number of different business disciplines beyond just managing currency risk. But building off of the point that Carl ended on, volatility, we're seeing it as well. You'd almost have to be not paying attention to any form of media to not see the impact of currency wars. I mean, just in the last quarter here, we've seen the devaluation of the Venezuelan bolivar. We've seen the Japanese yen really come off of its highs into a devalued position. And that is just a symptom of a number of very significant currency market movements. And it's really, Carl and I have talked on this in the past, it really was precipitated this level of volatility that we're seeing right now by the financial crisis. That was a real catalyst event to drive volatility to new levels there. But at the end of the day, you need to have an organization that can sense and respond to changes in the market dynamics. And that's where we're seeing a lot of companies really feeling the pressure right now. And as we think about that, there are really sort of 3 areas of innovation and changes within enterprises today that are either complicating or potentially simplifying the problem at hand. The first is internationalization. When we look at what's happened since the climax of the business or the financial crisis, as we monitor the earnings, and this is something that we do every quarter, we go through the earnings of about a mainstay of the Fortune 2000, and we're looking at how currencies are impacting the organizations. We're looking at how they're building out their international strategies. In about 2010, we saw a market increase in the appetite for corporations to begin to expand internationally. But what we're seeing is that is also bringing with it a tremendous amount of complexity. Virtualization is a concept that is really applicable across a number of different dimensions. And at the end of the day, what that means to you, and we'll go through this in a little bit more detail in a moment, is that there's more services and more capabilities that are now accessible, and this really builds off of the points that Karl was talking about, where you can respond very quickly to the changing market conditions and the risk that's inherent in the marketplace without necessarily having to go through what you may have traditionally looked at in terms of software investment. The last piece of this is speed. Given what's happening in the marketplace, given the competitive environment that we deal with, given the increased risk and volatility in the market, speed is always your friend here. But what we've seen across organizations is that that need for speed, more times than not today, is met with frustration because companies aren't as agile as they should be, and they need to really make this shift into the next level of sophistication and capability. And there's things that they can do today with their given processes and given systems that can help them get there, and then there's an approach to adopting technology that can even further their ability to be quicker to market with responding to change. So let's dig into each of these areas. So internationalization. We've done research in the Fortune 1000, and our, as we review the earnings calls, we're seeing well over 60% of CEOs informing the market that they have very significant expansion plans. And you see that there's a tremendous appetite, as Karl was pointing out in his section of the presentation, to go into frontier markets, into emerging markets, and you're seeing more and more companies get there through a combination of organic growth, but more increasingly we're seeing it through mergers and acquisitions. And that mergers and acquisitions situation really creates a tremendous amount of complexity. And it creates complexity in a number of dimensions. It creates the operational complexity because you now have to bring together different companies and look at building the synergies and looking at getting the economies of scale. You get the cultural or organizational stress that comes with bringing together different organizations. And you have a systems complexity. It's not uncommon for companies to end up with duplicative ERP systems. Whereas before they may have been on a single instance of SAP, they've now got SAP and Oracle, and they've got to make some decisions about which horse did they ride in the long term and how do they operate in the midterm. And I'll give you a kind of a worst case example of that. Tyco International is a company that grew almost exclusively through acquisitions, and as they had built out their acquisition strategy over time, one of the things that they had included in their investor deck was the fact that they had over 100 ERP systems within their enterprise, and managing any sort of enterprise process was extremely daunting in that environment. And they had an appetite to reduce and rationalize those systems over time, but that's kind of a worst case scenario. But we do see other companies that have 10, 15 different ERP systems. So if you're just on one today, count yourself lucky, and that is a big advantage, but it probably will change over time. Let's take on the next issue here. Let's talk about the virtualization. This is actually one that I love. This really builds off of the themes that Karl was advocating. If you think about what it was like when you had your first 8086 PC and the thought of upgrading the operating system or installing a new piece of software, you had disks, you had all sorts of headaches in there, and more times than not, at least my experience, and maybe this just speaks to my capabilities with modern technology, is I had to back out and recover from problems that I created during an upgrade or an install more times than I was able to successfully get through that. Now, you contrast that to what's available today. You look at your mobile technology, you look at the iPad, you see something that you want in the cloud, in the iTunes marketplace, on Amazon, you point, you click, it's downloaded, and not only is it there on your mobile device, but it's also already tapped into the network. So it has your understanding of who you are, where you are, what your interests are, so it can bring very specialized, meaningful content to you and help you do very specific things within your life, not trying to solve everything for you. It's a niche product there. And I think this is a model that you're going to see begin to become more pervasive within the enterprise computing world. This is a real drive to be able to leverage take the existing investment in your ERP systems, but build beyond that and get specialized capabilities that give you some differentiation or give you increased efficiencies or access to capabilities through the cloud. And the cloud-based technologies, I think, is really a game changer out there, and we're already seeing evidence of significant investment in that. You look as recently as October of last year, where SAP comes out in collaboration with a number of very top-tier banks talking about building their own financial services network, where they're going to be able to plug and play different capabilities on top of that, bringing together not only financial service providers, but virtual applications and data from the enterprise. I think that's a trend that we're going to see from a number of different providers out there in the future. Now let's go to the next area, speed. Speed is an issue that hits you in a number of different ways. When you have as much volatility as we have in the marketplace today, we see companies we see finance organizations being asked to provide answers faster. So what happened when the Bolivar devalued? Well, you saw a number of companies come out within days saying this is going to be the impact to my profitability. They're able to sense and respond that quickly, and that didn't come from just a clerk trying to do some numbers. That was a question that came from the board. That was a question that came from the CEO and the CFO, and those organizations were very capable of very quickly identifying what the potential impact is and communicate that to the market. So responding in real time or near real time. But that is not the typical response. This is a very difficult environment to deal with, and it's difficult in the current environments as we see it to be able to respond to market events, be able to provide information back, because the data is all over the enterprise, and it's difficult to sort through all that data to get to the information that you need to make a decision. But with the advent of the cloud, the advent of these new services capabilities that are coming in from the outside, you can decrease that cycle time. You can implement those capabilities faster, and you can get access to the information and make decisions faster in this new environment. And that's really going to be a key trend. FireApps is an example of a company that does just that, comes in as a niche application providing insight and visibility to a very complicated problem, foreign exchange. And we could do it in a very short period of time. Now, the old world of solving this problem was to go in and invest in new software projects, where IT projects were going to be the way that you continue to build out this capability. And it's always this challenging dialogue between the business and the IT organization. Should I build it or should I buy it? And if you look at how much money is spent in IT projects right now, it's pretty staggering. You've got, and the other issue with it is that most of the investment that's going into IT projects today is just to basically maintain what's already been done. So we're upgrading our instances of SAP, or we're combining an Oracle into an SAP environment. We're just basically not moving the ball forward. We're just keeping the ball in play, so to speak. And these big projects also have a fairly high failure rate because they are very complex. And if you're really doing something that's unique and differentiating, you may not even have all of the intellectual horsepower or understanding of how to solve that problem in the hands of the people that are actually implementing the software. So that's where the cloud-based technologies are much, much more attractive in helping companies build things out. But the question then comes down to, when do I go to the cloud and when do I build it myself? And from my kind of pragmatic view on this, there's a very simple way to rationalize this. My guess is anybody that's ever asked for an IT resource to do anything today has been told, I don't have any IT resources to give to you by somebody within the IT organization. That's typically what we hear because they're already busy on a number of different things. So if a company's looking to build versus buy, I think it really comes down to, given the fact that companies have a lot already invested in ERP systems, if they're going to build it, it really should be something that is going to have a tremendous competitive advantage for them in the marketplace, a real differentiator. it's something that sets them apart from the marketplace. If it is something that is extending a financial capability or other parts of the business that is relatively similar across businesses, or you don't necessarily have that intellectual core competency within your business, go outside and get it from the cloud, because you're going to be able to get that done a lot faster, and you're going to allow your IT organization to spend time focusing on the core ERP systems. And those ERP systems are really critical to your business. So one of the things that you have to think about here, though, is that technology in and of itself is not the answer. And this is something that we have seen time and time again out there. Companies have spent, and I'll give you a really very real example. You know, companies have spent millions of dollars on their accounting systems, their ERP systems. And for whatever reason, even though these systems come with every piece of functionality that you can imagine, they'll do something like not turning on the multi-currency accounting functionality, or they won't operate that accounting system on a real-time or near real-time basis. They'll do it almost in a batch mode, where the organization will do their data entry for accounting postings at the end of the month, or they'll close it out even, you know, T+2 after the end of the month. In this market, in this real-time risk environment, that's very dangerous. So at the end of the day, you really need to begin to, you know, take advantage of the systems that you have, but the people and the processes have to work to maximize the capabilities that are provided by those ERP systems. That's one of the key things that I would recommend, is take advantage of what you've already got there. And this is really a message to both the CFO and the CIO, because I still see companies trying to build their businesses, become increasingly international, taking on new operational and market risks, but they haven't got the foundation in place from a systems, people, and a processes standpoint. It's not just enough to get the new technologies in-house. So as we close that out, you know, here's just some very pragmatic thoughts on how to continue to adapt to the current market environment that we're dealing with. One is, get the most out of your accounting systems. Make sure that your systems are utilized to their full extent. You know, from a foreign exchange standpoint, to build off of Karl's perspective on currency risk, make sure people are doing postings on a timely basis. If they're not, that's an issue that needs to be dealt with, because if they're doing it at the end of the month, you know, think about it in terms of, if you need to make a turn and you're only able to change the direction of the steering wheel, you know, every 50 feet or every 100 feet, versus being able to do it as the turn really happens, you're going to drive off the side of the cliff sooner or later. The other thing is, make sure that multi-currency accounting functionality from an FX standpoint is turned on, that it's utilized, and that you're able to monitor adherence with that policy. We still see a number of companies that really struggle with this. So when it comes to managing a risk like foreign exchange, and people don't have timely data in their accounting systems, and the accounting isn't actually been done correctly, they're going to get nailed by foreign exchange, because there's going to be little surprises or little mistakes when you have significant volatility show up as bigger issues, because they're really drawn out and made a lot larger just because of the large directional movements that are out there. The other piece of advice that I would tell people to really seriously consider is look to the cloud for any sort of specialized data analytics. Your accounting systems, your ERP systems, those are your data sources. Make sure the details are right, but to embrace and extend that, given the fact that your IT resources are not as readily available as you would like them to be, but you do need to make those decisions quickly. You need access to that information. Those cloud-based apps that are going to be increasingly easier to download and get up and running and get visibility to are really going to help you embrace and extend the investment in your existing IT deployments, but they're going to help you be faster to market, faster to make decisions, and they're also going to deal with the fact that many of you are probably sitting in environments today where you've got multiple ERP systems. The cloud is the only way to harmonize information across multiple ERP systems. And the last thing is, you know, again, build only what you can't buy. Build something that's going to give you a competitive advantage, or that you've got a core competency around, and the rest, you know, look to the market. Look to those rich app environments that are out there that are coming in from cloud-based service providers, and take advantage of those and continue to move the business forward as quickly as possible. I think that's a trend that I already see in motion out there. with that, Carl, I think I've wrapped up my section of the presentation.
Thank you, Andy, for your great insights. I know there's a lot of material to cover in a short period of time, which at this time we'll go ahead and launch our second of three polling questions. You guys should be seeing that up on your screen here shortly. And at this time, again, I just wanted to have a friendly reminder for everyone who is attending this session for CPE credits. You will need to answer all three of our polling questions to receive full credit. We do have a couple questions from the audience, so hopefully we'll be able to get to one or two. We're kind of tight on time, and I know we had a lot to cover today, so I definitely appreciate it, Karl and Andy, for sticking within the time frame. So I'll just go ahead and give the audience just 5 more seconds or so to finalize their answers on our poll. And with that, we'll go ahead and kick off our first Q&A here. This is actually for both of you, Karl and Andy. What strategies are most important for optimizing corporate currency risk management? Not sure who wants to go first.
Maybe I'll jump in first here. Really good question, and I think it's pretty important to be thinking about it right now. From a strategic perspective, a lot of companies have figured out the need for hedging, the need to pay attention to what's happening from a currency perspective. But I think the thing that's being missed right now is that volatility is actually a good thing. We have this real attitude that volatility is to be avoided at all costs. But I think that a lot of corporates need to start thinking about how to use volatility during the execution phase of trading, while also managing or using hedging instruments to protect themselves against risk in the longer run. So the key really is to use things like market orders and other strategies to optimize that market timing piece while managing to protect yourself against risk in the longer run. Andy, did you have any thoughts on that?
Yeah, I think the other thing I would add to that, I agree with everything that Karl's saying, but I think the other thing is even before you get into the execution side of this is on a pre-trade basis, I think it's critical to really make sure you have a thorough and complete understanding of your exposure and make sure that you understand before you take an action in the marketplace, is it really going to have the intended result that you desire? Because we still see companies struggle with not having the right information, not at the right time, and there's issues with the information that they have, which actually compromises the execution side of that. So, digging in and understanding the exposures and making sure that you understand where you've got the internal offsets, where you've got some natural hedging opportunities in concert with the execution side is really a best practice that we've seen out there.
Great. Thanks for that, Karl and Andy. I really appreciate the insights and the knowledge that you guys were able to share with us today. With that, we're actually kind of close to the top of the hour, and we have a couple other things to get accomplished here before we wrap this session up. So we do have a few last-minute kind of housekeeping items. At the end of today's webinar, you will have an opportunity to participate in a short survey. As we mentioned earlier in the session, we truly value your feedback and appreciate the time that you give us in order for us to continue to deliver great content. At this time, you can also easily request to connect with both Karl and Andy with a click of a mouse. And we also ask for you to join us on proformative.com to continue this great discussion. And if you have any questions regarding the CPE, please contact Chris Brower at proformative.com. Just also want to give you all an opportunity and remind you of our Proformatech conference occurring next month, March 20th, at the Hyatt SFO in San Francisco. It's a great event where you'll be able to learn and hear from some world-class speakers around best practices with new technologies within the finance, accounting, and treasury functions. Again, you'll be able to easily register for the event during the post-event survey. And if not, you can check us out on proformatech.com. And I want to thank Karl and Andy for their time and insights. Both of you guys are great speakers and leaders in your field with an excellent source of information on today's topic, so I really appreciate the time, guys.
Thank you.
Thank you, Karl.
Definitely, as you pointed out there, please keep in touch. I know the Q&A session got cut a little short there, so we'd love to hear from you.
Yeah, we'll definitely make that happen. And I also want to again thank Western Union Business Solutions. Without their support, we wouldn't have been able to bring this event to you. And with that, we are going to move on to our final and third polling question. We'll go ahead and launch that now, and hopefully all of you can see that. At the end of this polling question, I'll go ahead and end the session, at which point the post-event survey will go ahead and launch. And again, it's just another 60 seconds, folks. We really appreciate your feedback, and we look forward to seeing you again at another Proformative event or online at proformative.com. Thank you again for your time, and have a great weekend. And goodbye, folks.